Hi everyone, my name is Rachel Stern. I'm the founder and managing partner of GovTech Ventures, and we're back for another GovTech Go-to-Market series of videos today. And I really want to talk about the pre-seed trap within GovTech. I've been seeing a lot of pre-seed founders lately raising on safes at valuations that feel great in the moment, but when it's time to raise a real seed round, they're getting stuck. It's important to realize that at this stage, a safe isn't a free valuation, it's deferred reality. If you set the bar too high early on, you aren't eliminating dilution, you're just postponing a reckoning. To understand why this happens, you have to look at the mechanics of a safe. A safe isn't a loan, and it isn't technically buying stock yet. It's a promise. An investor gives you cash now, and in exchange, they get ownership later when a professional firm sets a formal price for the company. The valuation cap is one of the parts of that promise. Think of it as a ceiling. It's the maximum price at which the early investor's money converts into shares. So if you set a $20 million cap, you're essentially betting that your company will be worth at least that much by your next round. This is where the math can sort of get tricky in GovTech. We see general AI startups raising massive caps because they can scale almost overnight. But in government, you can have the best AI ever, and you're still looking at a sales cycle that's 60 days on the low end for a pilot and 18 months on the high end for a major contract. If you spend 18 months waiting on a contract to close, your actual value might only move from 5 million to 8 million. If your safe cap was 20, you've created a massive gap between your price and your value. Most institutional seed rounds look like this. You raise $3 to $5 million and you sell about 15 to 25% of the company. A new lead sets the price based on your traction, and if your pre-seed safe implies a valuation that the math can't support, a few things can happen. The seed round can become painful. You deal with down rounds and unhappy early investors. You start chasing the numbers instead of building the business the right way. You optimize for anything that might justify the high cap. That leads to rushed hiring and forced growth narratives. And the momentum can stall. You can spend months stuck between rounds, burning cash while you're trying to find an investor to verify a number that the market doesn't believe in. Sometimes a lower valuation cap in the safe is actually healthier. It gives you the oxygen to hit milestones instead of defending a number, and you can tell an honest story to the next investor and build leverage through progress, even during those long government sales cycles. Work backwards from your next raise. If you know you'll need a strong seed lead and a clean cap table, your pre-seed pricing should enable that, not fight it. A slightly lower cap that leads to a clean table and a motivated investor is almost always better than a headline number that boxes you in later. Capital is a tool. Use it to build leverage, not constraints. More next week.